With major stock market indices hovering around all-time highs, some investors continue to worry about the state of the economy. While trends around inflation and jobs have been positive, putting the Fed in a position to cut rates later this year, there are still many concerns in areas such as real estate. What do long-term investors need to know about stresses in the real estate market? Housing prices are at record levels. Perhaps more than any other sector, real estate has borne the brunt of higher interest rates over the past few years. Recent developments in both residential and commercial real estate have only added to uncertainty in these markets. Housing starts have stabilized and are beginning to creep up, and there has been a rebound in existing home sales as well. Given where prices are and the level of underlying demand, many economists hope that more flexible commissions could help to boost the housing market in the years to come. This affects monetary policy as well. The fact that shelter costs make up over a third of the consumer price index basket is one reason the pace of inflation improvements has slowed. At his most recent press conference, Fed Chair Jay Powell addressed this issue by saying, "There's a little bit of uncertainty about when shelter price improvements will happen, but there's real confidence that they will show up eventually over time." Commercial real estate prices are beginning to stabilize. While the banking sector has stabilized since last year, commercial real estate has continued to struggle, especially in the office and multifamily segments. One consequence of Fed rate hikes across history is the impact on banks, including the various savings and loan crises that occurred in the 1980s and 1990s. Ideally, these pressures begin to ease as the Fed loosens monetary policy in the coming months. Refinancing activity has stalled due to high interest rates. Thus, there are many factors impacting all areas of the real estate market, including high interest rates, the settlement on commissions, ongoing issues with CRE loans, and more. While interest rates are only one of these factors, transaction volume should improve, and financial pressures should ease as rates begin to moderate. Since the conditions that created this environment over the past few years could begin to change quickly, investors should continue to focus on the longer-term economic and market trends rather than on the rear-view mirror. The bottom line? While there are many issues across both residential and commercial real estate, there are positive developments as well that could boost activity, especially as the Fed begins to cut rates. Investors should continue focusing on long-term trends and staying diversified. Thank you for listening. For additional information, please visit mraadvisory.com.